Welcome to The Explainer. Today, we're digging into a systematic approach for trading the NQ futures market. It's called Trader Kane's lab model, and it's all about having a clear set of rules for every single trade.
It's kind of the holy grail for a lot of traders, right? Finding that repeatable edge. Well, this model, it aims to provide exactly that, a super structured framework to help you cut through all the noise and handle that crazy NQ volatility.
All right, let's jump right in. Here's what we're going to cover. We'll start with why a trader needs an edge in the first place. Then we'll decode what makes this lab model tick. From there, we'll get into the actual blueprint, the two main trade setups, how to manage them, and finally, how to take all this theory and actually put it into practice.
So first things first, a trader's search for an edge. Look, at the end of the day, every successful trader is looking for that little advantage. This strategy is really an attempt to pin down and systematize one of those edges. The whole idea is to move away from just guessing and move toward a clear, repeatable process, especially when the market feels totally chaotic.
Okay, before we can actually build the strategy, we've got to learn the language. Think of these as the building blocks. So let's unpack the core concepts that this whole model is built on.
First up, we have premium and discount. This is a really simple, but honestly, a super powerful way to look at the market. All you do is you take a recent price move, you find the halfway point, and boom. Anything above that is premium. Think of it as expensive. Anything below is discount. That's your cheap zone. The whole strategy really hinges on this one idea, that price always wants to get back to a balance between these two.
And that leads us right into our next concept, the balanced range. So when price moves from that premium zone back down to the midpoint or from discount back up to it, we call that range balanced. Now here's the key takeaway, the really important part. The model assumes that any range that's unbalanced is eventually going to try to find that balance. And that gives us a predictable target for our trades.
All right, now for one of the big triggers, SMT Divergence. You know how the NASDAQ, the NQ, and the S&P 500, the ES, are like best friends? They almost always move together. But every now and then, they don't. One might make a new high, but the other one just can't. That's what we call a crack in correlation. And that little disagreement, it's a massive clue that a reversal could be right around the corner.
And last but not least, we have our actual entry signal, the inverse fair value gap, or iFVG for short. So a regular fair value gap is basically just an inefficiency in the market, a little gap in price. But when a candle closes all the way through that gap, it flips it or inverts it. This is our big confirmation. It's the market screaming that momentum has shifted, and it gives us a super precise spot to get into a trade.
Okay, so we've got all our building blocks. Now let's put them together and look at the actual strategy blueprint. This is where we get into the nitty-gritty, the hard rules of the game, the specific parameters you need to follow to put this whole thing into action.
And just look at how specific these rules are. This is not some vague feel the market kind of theory. It is a laser-focused plan. We are trading only the NQ. We're using the ES only for that SMT divergence. We do our homework on the higher time frames, the 4-hour, the 1-hour, but we pull the trigger on the lower ones. And this is a big one. The trading window is super tight, just 3 hours from 10 a.m. to 1 p.m. Eastern. That's designed to hit that sweet spot of daily volatility.
All right, the rules are set, so now we can get into the playbook. The lab model really boils down to two main trade setups that use everything we've just talked about, the reversal and the continuation. And it's really, really important to get the difference here. A reversal trade, you're essentially betting against the recent move. You're saying, okay, this push is running out of steam and it's time to swing back towards balance. A continuation, though, is the opposite. You're going with the flow. You're using a small dip as a chance to hop on the bigger trend and ride that momentum.
So let's break down the reversal trade. Think of this as a very specific recipe. The order of operations is absolutely critical. First, you identify your target, that unbalanced range on a higher time frame. Then, you wait for that 10 a.m. candle to close. Next, you need a false move, a sweep of the high or low. That's trigger number 1. Trigger number 2 is our SMT divergence. And only when you have all of that do you start looking for that iFVG to get in. Every single piece has to be there, no exceptions.
Now, the continuation setup is a little different. What you're looking for here is a situation where a small, lower time frame range has balanced itself out, but the big picture, the higher time frame, is still very much unbalanced. So you wait for that little pullback, you look for that SMT divergence to show up, and then you use the iFVG to jump in, but you're trading in the direction of that bigger unresolved trend.
Finding a great setup is only half the battle, right? It's totally useless if you don't know what to do once you're in the trade. So let's talk about execution and management, the specific rules for your stop loss, your profit targets, and how you manage the trade while it's active.
And the rules here are super straightforward. Your stop loss, it always goes just above or below the recent high or low that got you into the trade in the first place. The logic is simple. If the price goes back there, your idea was wrong. For take profits, a reversal is aiming for the midpoint of that unbalanced range. A continuation can aim for that same midpoint, or you can shoot for a new high or low, since you're trying to ride the bigger trend.
And this next one is a huge rule for managing your risk. You have to do this. Once the trade is halfway to your profit target, you move your stop loss to break even. Just slide it right up to your entry price. This immediately takes all the risk out of the trade. It's how you make sure a nice winning trade doesn't suddenly turn around and become a loser. Okay, so we've covered the theory, we've got the blueprint, and we know the rules. But you know what? The final step is always the most important one. It's all about taking this out of the lab and into the real world.
And really, this gets to the heart of what trading is all about. It's not about finding some magic bullet that wins 100% of the time. Does that even exist? No way. It's about finding a process, a system that has a statistical edge, and then having the discipline to execute it over and over again so you can stay in the game long enough for that edge to actually work in your favor.
So that leaves us with the ultimate question. We've laid out the whole model for you, but honestly, this is just the beginning. The only way you're going to know if this strategy or any strategy actually works for you is to get your hands dirty. You have to do the work. Backtest it, collect your own data, analyze your results, and let the numbers, not your gut feelings or what you hope is true, tell you what's really going on.